Alrighty guys, welcome back. Fundamentals of credit analysis. All right, when it comes to credit analysis, helping us determine our required rate of return, that's going to dictate the price we're willing to pay for that particular bond. So we'll describe, well, what is credit risk? What's the probability of loss? What are the components of credit risk? Is it collateralized or not? We'll talk about bankruptcy. Well, in the event the company has a Chapter 7 liquidation, this absolute priority rule, who gets paid, how much, and in what order. So we'll talk about senior debt, subordinated debt. And remember, good news and bad news, guys. When you have lower credit risk, that's not necessarily good news. It's good news in terms of, yeah, you're assuming less risk, but then don't forget, you're probably going to get a lower rate of return. Now, if you're getting a high yield, good news, don't forget, you're probably getting a higher yield because you're assuming more credit risk. So again, we want to always discuss with our clients full, disclosure, pros and cons. We'll talk about different credit rating agencies. We'll talk about the concept of notching, the risk in relying upon somebody's credit rating if they get that wrong. And obviously you relied upon that. You might have understated your required rate of return and overpaid for those securities. And don't forget, this also has a lot of overlap with equity analysis, because when you come up with your valuation in equity, many times we use, well, what's the required rate of return for the bondholder? And then we tack onto that an equity risk premium. So this affects not only value of the debt, but the equity as well. Understanding the concept of the 4 C's, which we'll go through: capacity, collateral, covenants, and character, and how that helps you better assess required rate of return. Now, the big one here is the ratios. The good news is there's not a single ratio here that we didn't already cover together in accounting. Now we're just applying that tool, right? So all of a sudden that mountain of information is shrinking. So we're going to look at those same ratios: the quick ratio, the current ratio. We'll look at cash conversion cycle. We'll look at degree of financial leverage, degree of operating leverage. So all the ratios we look at to help us better assess risk and required return. When we look at credit quality and the key financial ratios, we want to understand that the ratios are driven by the numbers, and the numbers are driven by the estimates and the methods, right? Management bias. So do we maybe want to do some adjusting of financial statements before we assess and use the ratios? We'll revisit that a little bit. We'll talk about the factors that influence the level and volatility of yield spreads, so the spread above your benchmarks, right? So whatever that spread is, as the spread goes up, your required return goes up, the value goes down. We'll talk about some special considerations, again, with respect to sovereign debt. So it's not just about assessing the ability to pay, but the willingness to pay. So political risk. I mean, look, if in the U.S., if a corporate issuer, doesn't pay back the debt and they're capable of doing it, obviously you can sue them. Okay, but if it's a sovereign government, okay, the political risk, what's the risk that they might say, now we're not going to pay you back? Or they pay you back, but all of a sudden they printed lots of their currency and they've given you now a return, and that currency has lost its value. Okay, so all those different little nuances we'll go through. So for the most part, this reading is mostly theory. Okay, so there's not a lot of math involved, and the ratios, while that seems math intensive, is just the direct repeat of what we've already seen. Okay, we're just applying it. So let's jump in, let's do it. Okay, guys, our next reading here is relatively straightforward. So the goal is obviously to master these points, because for the most part, there's no math involved. So you read it through once, take the notes as we go along together, do your homework, correct your mistakes, you'll have it nailed down. So the fundamentals of credit analysis. So the first thing they want us to do is basically describe what is credit risk, and then the risks, the various risks that affect corporate bonds. Now, big picture, how do we value any asset? The value of any asset today is based upon forecasted future cash flow, and then we've got to determine the appropriate required return. So this required return has got to compensate us. This is our compensation for all risk assumed. Okay, so if any source of risk should go up, we've got to increase our discount rate, increase our required rate of return. So with no change to the numerator, but we're increasing our required rate of return, what's that going to do to the market value of that asset? It's going to bring it down. So we want to look at the various sources of risk. So first of all, describing the term credit risk. Well, this is the loss resulting if the borrower fails to make the payments of principal and or interest. Now, there's actually two separate components of credit risk. The first is the default risk itself. This looks to quantify the probability that the debtor is going to fail to make the payments of principal and interest as they become due, according to the terms of the agreement. But that's only one piece of the puzzle. The second piece of the puzzle is, okay, if they default, how severe is that loss? How large is that loss going to be? So that's the concept of loss severity, okay? So this is the portion of the bond's value that an investor would lose if that default actually happened. So the percentage of principal plus any accrued interest that they're able to recover, well, that's first called the recovery rate. So in the event that we go into default and there's a bankruptcy, how much money do you think we're going to be able to recover? That's what we calculate first, is the recovery rate. That then leads us to the calculation of loss severity. That's 1 minus the recovery rate. So the expected loss, you don't add these together, you multiply. What's the default probability times the loss severity, okay, given the default? And remember, that's 1 minus the recovery rate. So we know it's mutually exclusive, collectively exhaustive. Okay, so if there's $1 million of debt outstanding and we think we can recover $600,000, then the loss would be 1 minus the $600,000 or $400,000. Multiply that by the default probability, and therein lies your expected loss. Okay, another source of risk is what we call spread risk. Obviously, this is the premium above and beyond risk-free bonds. And we want to get this premium, we want to get this spread to compensate us for that additional risk we're assuming when we don't buy US or German bonds, okay? So if this bond is riskier, then we're going to demand a spread. And as that spread grows, the market's going to demand a bigger return above and beyond the relevant risk-free. So anytime we have an increase in the spread above that risk-free rate, well, that's going to reduce the value of the bond. Because as we saw earlier, should the spread above the risk-free rate go up, so if that premium, if that spread increases, well, then your overall required return, your discount rate goes up. Discount rate goes up, value comes down. Okay, now, downgrade risk, or what they call credit migration risk. So synonymous terms, downgrade or credit migration risk. So that's the risk that the issuer's credit worthiness can deteriorate during the term of the bond. Obviously, the shorter the term, the less risk there is. The longer the term, the greater the risk that over the term of that 30-year bond, then we could have a deterioration in the credit rating, which would then obviously cause the credit rating agencies to downgrade the credit rating of the issue. If they downgrade the credit rating of the issue, then what's the ripple effect? Then we're going to demand a higher spread above and beyond the risk-free rate to compensate us for that additional risk we're assuming. You increase your required rate of return, what's that going to do to the market value of the bond? Bring it down. Okay, and then we have liquidity risk. So we know liquidity risk, the risk we would have to sell that asset at a discounted price if we want to liquidate it quickly. So how much would we have to discount the price to liquidate it quickly? So if there are insufficient volumes, if it's illiquid, then we're assuming greater liquidity risk. So to compensate investors for that liquidity risk, again, we look at the spread, the yield premium above and beyond the risk-free rate. Now, this is part of, okay, the market liquidity component is part of that overall yield premium or spread. So how do we measure liquidity risk? Well, the bid-ask spread. So think about it. Grandma's asking $1 million for her house. People are only bidding $500,000. Well, I hope grandma's comfortable because she's not going to be liquidating, selling that house anytime soon. But if grandma drops her asking price to, let's say, $700,000, and the bids start coming up to 680,000, as that spread decreases, pack your bags, Grandma, you're going to be moving pretty quick. So anytime we have a large spread between the seller's asking price and what the buyers are bidding, well, that indicates that issue is less liquid. And that means there's a higher level of liquidity risk. The higher the liquidity risk, the higher the spread. The higher the spread, the higher the discount rate, the lower the value of the security. Now, there are two factors, issuer-specific factors, that are going to help us determine liquidity risk. One is the size of the issue, okay, the size of the issuer. So generally speaking, the lower the amount of publicly traded debt that issuer has outstanding, the less frequently that debt's going to trade, the higher the liquidity risk. So size is one of the key issues here, okay? And then the credit quality of the issuer. So when you have a relatively low credit quality, you're going to have higher liquidity risk, more difficult to flip that security and convert it to cash. Okay, now, seniority rankings, okay, with corporate debt. So in the event of a bankruptcy, in the event this corporation goes bankruptcy, the first thing we want to be mindful of, there's two types of bankruptcy you're going to see. One type of bankruptcy is when there's no hope. So in the US, we call that a Chapter 7 bankruptcy, where we're going to liquidate the company. It's going to cease to continue operations. We're going to take the assets, sell them, convert them to cash, and then use the cash to service the debt. So that's a Chapter 7 liquidation. But then when there's hope for the business, that's a Chapter 11 bankruptcy. That's a reorganization. Okay, so we want to be mindful of what type of bankruptcy is being referred to. That's going to help us dictate and decide the type of risk we have in terms of loss severity, as you're going to see. Okay, now, first things first, capital structure of a company. Whenever we think about capital structure, just think about a balance sheet. Balance sheet cannot be used to directly value a company, but it could give you a lot of information about their sources of capital. So how much debt versus how much equity? We know the deal. The more debt you have, the less equity you have, the higher your debt to equity, the higher the risk of financial distress. That's the bad news. The good news is, though, whenever you have a relatively low amount of equity, what does that do to your expected return on equity? Increases it. So yield and risk, we know, go hand in hand. So capital structure is very important. Okay, the composition of that balance sheet, the debt and equity, across its operating units. Now, seniority ranking. As a general rule of thumb, companies can issue debt with different rankings in terms of seniority, who gets paid first in the event of a default. So, we have the most senior or highest ranking debt. Well, they have first claim on the issuer's cash flows and assets in the event of a default or restructuring. So what does that mean? If you are the most senior, then the risk you're assuming goes down, but then again, so would your required rate of return because you're assuming less risk. Now, there are two types of senior debt. The first type is secured. So that means certain assets have been pledged as security in the event of a bankruptcy. So that debt is secured. In the event of a bankruptcy, we have rights, first rights to certain assets known as the collateral. If it's unsecured debt, a synonym for unsecured debt is a debenture. That simply means unsecured. So they only have what's called a general claim on the issuer's assets and cash flows. So in the event of a bankruptcy, we've got to make sure all the secured creditors get paid first, and then the unsecured claims get paid. So when you're unsecured, you're assuming more risk. Therefore, you're going to demand a higher rate of return. So secured debt ranks higher than unsecured debt. Piece of cake whenever there's a priority of claims, okay? Now, within each category of debt, secured or unsecured, there are sub-rankings. So let's start with the secured debt. How do we know it's secured? There's collateral pledged to the creditor that could be seized and sold and used to satisfy the debt in the event of a bankruptcy. So there could be the ones with the first rights to the property,
A first mortgage, mortgage means the collateral is real estate. It could be senior secured, junior secured. So obviously we go from the highest rank to the lowest rank. So when you're the highest rank, you're assuming the least amount of risk. You're going to get the lowest relative yield. As your level of risk assumption goes up, you'll demand a higher rate of return. Piece of cake. And that's all where collateral has been pledged. Unsecured debt means there's no specific assets securing that debt. So the unsecured doesn't get paid anything until all the secured creditors take their assets first. So the unsecured debt could be divided into senior claims versus the junior claims. Again, the most senior unsecured debt would, relatively speaking, amongst this group, assume the least risk. They would therefore demand and deserve the lowest yield. The junior subordinated debt is assuming the most risk, so their required rate of return would be relatively higher. But remember, secured always comes before the unsecured. Okay, so secured always comes before the unsecured. Secured has first rights to the collateral that's been pledged. Okay, now recovery rates. Now, in the event of a bankruptcy, let's say we have all these different classes of creditors. So we've got secured creditors, first lien, senior, junior, unsecured, senior, senior subordinated. What if we run out of money at a particular level? Like, what if, for example, there's enough money to pay off the first lien, there's enough money to pay off the senior secured, but then there's not enough money to pay off the junior secured? What if we ran out of money? Well, that means the unsecured debt is going to get zero, so they're not going to collect anything. If you run out of money at a particular level, how would all the creditors at that particular level share in the remaining assets? So let's say the junior secured is owed $1 million, but the collateral is only worth $800,000. Then how would those junior secured creditors share the $800,000 when in total they're owed $1 million? Well, they would share on a pro rata basis. So all creditors at the same level in the capital structure are treated as one class despite the coupon rate offered on their bonds and when their bonds are maturing. So that makes no difference. So if all of the creditors that are remaining to be paid, junior secured, and there's not enough money to pay them all, how are they going to share? Pro rata. So when we run out of money at a particular level, all the creditors at that level are going to share on a pro rata basis. So let's say, again, A is owed $10,000, B is owed $15,000, C is owed $25,000. Add it all up, what's the total amount of debt at this level? Well, the 25 plus the 15, the 40 plus the 10, that's 50. So what if, for example, we only have, let's say, $30,000 available to pay all the creditors at that level? How much money would A get? Well, obviously, A is not going to get the full 10. What we would do is take their 10 divided by 50, the amount we owe to A, divided by the total amount at that level, and then multiply that by the cash available. And if the cash available is 30, they're going to get 10 divided by 50. They'll get 20% of the 30. A is going to walk away with $6,000. And then so on for B and C. Okay, B wouldn't get the full 15. Okay, they would get 15 divided by 50. Or they would get 30% of the cash, and so on and so on. Okay, now, recovery rates are generally the highest for the senior most class, okay, in the priority of claims. Okay, this recovery rate is going to fall as you get lower and lower in the ranking of the security. So what does this all then, culminate in? The lower the seniority of the bond, the greater the credit risk, and that's why you demand that higher yield to compensate you for that additional risk you're assuming. Okay, now recovery rates, in the event of a default, that doesn't mean you're definitely out of luck. You could get some money. You may not get all your money, but you may not walk away with zero either. So what are the factors that affect recovery rates? Well, that's heavily dependent upon the industry, and it's heavily dependent upon when the default occurs in the credit cycle, which is highly correlated with the business cycle, the economic cycle. Recovery rates tend to be lower in industries that are very sensitive to economic performance. So if there's a downturn in the performance of the economy and that's when we go into default, you're probably going to recover less. Recovery rates are also, they tend to be lower when we're near the bottom of a credit cycle, an economic cycle. Okay, so in the event we hit bottom in the economy, so we're in a recession or a depression, okay, volume of bankruptcy is going to be very high. Okay, so there's going to be a lot of distressed securities. So the chances of you getting your money back decline depending upon the industry that you're in, how sensitive it is to an economic downturn. So if you're very sensitive to economic performance, you sell luxury goods, well, your recovery rate is likely to be lower in that type of industry. And then where we are in terms of the economic cycle. If we're in a recession, okay, obviously you're going to collect a lot less money at that time. Now, recovery rates are not only dependent upon the industry, they're also dependent upon the individual companies within the industry. And a lot of that is dependent upon their specific degree of financial leverage, their type of capital structure. So all things being equal, if a company has a relatively high proportion of secured debt, so they've got a lot of the assets already pledged to the secured creditors, that makes it less likely that the lower ranked debt will get anything. So some of the factors are related to the industry, where we are in the economy, and then related to the specific company. It's individual capital structure, and then the type of debt within that structure. Okay, now this rule of absolute priority. This is what applies in a Chapter 7 in the U.S., a Chapter 7 liquidation, where there's basically no hope for the business. So the assets are going to be seized, sold, converted to cash, and then the cash will be used to pay the creditors. Remember, the secured creditors have to be paid in full before the unsecured, the general creditors. And within those classes of secured and unsecured, the senior always gets paid off before the junior or subordinated debt. We then pay off, if there's enough money to pay the secured and unsecured creditors, we then pay the claims of the preferred equity, and who's last in line in the event of a bankruptcy? Common equity. That's why common equity is the most expensive. They assume the most risk, therefore they're going to demand the highest yield. Okay, so we know, and this is the key point here, you got to know this order, but this only applies when the company is liquidated. Secured debt has first rights to the assets that have been pledged as collateral. Now, if the collateral's value is less than the amount owed, should the collateral, the pledged property, be less than the full amount owed? I'm owed $100,000, but the collateral's worth only $90,000. Well, then we're going to go to the back of the line in terms of any excess. We're going to be considered an unsecured creditor for any excess. Granted, senior, but now we've got to wait for all the other secured creditors to get paid. Okay, unsecured debt. Unsecured debt has the right to be paid in full before anything is paid to the preferred or common equity. Senior claims always have priority over the junior claims, okay? Now, in practice, bankruptcy does not always mean the company's going to be liquidated. In practice, many times we're dealing with a Chapter 11 bankruptcy in the U.S. where there's hope for the business, in which case we're going to reorganize the business. And the way a Chapter 11 bankruptcy works in the U.S., all the unsecured creditors, the impaired classes of claimants, the people who stand to lose money, people who are going to get less than the full amount owed to them. So that's generally the unsecured creditors as well as the stockholders. If we have a situation where we think there's hope for the business, all the impaired classes, the unsecured creditors and the stockholders, will get to vote on a plan of reorganization. Now, you don't need unanimous consent to approve this plan of reorganization. You'll never get everyone to agree. Generally, it's like a supermajority have to agree on the plan of reorganization. So what happens when there's this plan of reorganization, once the court confirms it, then that means it's binding on everyone, whether they agreed to the plan or not, okay? So The resolution of this, obviously, in a Chapter 11 can take time. There's a lot of legal and accounting fees that are involved in a Chapter 11. Okay, so normally the claimants are going to have to negotiate and compromise. The key is, though, in a Chapter 11, this means that the junior creditors are probably going to get more than they would have gotten under a Chapter 7 liquidation. So if we can help save the business, that means the people that are probably going to benefit the most are the unsecured creditors, and the stockholders. They're probably going to get more than they would have gotten in the event of a Chapter 7 liquidation. Now, in the U.S., there's a tendency towards trying to save the business, a Chapter 11 reorganization. Okay, so that means the junior claims, the stockholders are going to do better than they would have done in Chapter 7. So their recovery rate tends to be higher. So that means the loss severity tends to be lower. Conversely, in the UK, there's a bias towards, well, you know what, let's liquidate this company if they're in trouble. And then the most senior claims tend to do better because we're going to make sure they get paid before any general unsecured creditors get anything and before the stockholders get anything. So in the UK, the banks, the senior claims tend to get more than they would have gotten in a Chapter 11 reorganization.